Hi, myself Sharath Saju. Today I am going to explain an individual report of business analytics and intelligence. Introduction. The UK's online women clothing retail business has grown rapidly. E-commerce and consumer behavior have fueled this expansion. Due to the increasing rivalry in this business, organizations must understand the elements that affect their pre-tax earnings to create effective growth and profit strategies. This study analyzes profit factors in UK online women clothing selling, and this research examines major financial and operational elements such as gearing, liquidity ratio, shareholders' funds, and turnover to identify drivers of profitability in this dynamic business. And focuses on major financial and operational elements in the car sector. And it also helps shops make informed decisions and improve financial performance. Then descriptive statistics. Here we evaluate the table of 10 UK online women apparel retailers, financial and operational factors. First, the gearing percentage shows the proportion of a company's capital structure supported by debt. The sample's mean gearing percentage is 72.60%. It's indicating that these enterprises rely heavily on debt. Higher leverage raises financial risk but boosts profitability in good times. Next, we look at a company's liquidity ratio. These women's fashion shops mean liquidity ratio is 1.22. It's indicating a good liquidity, and a value greater than 1 implies that they have sufficient current assets to meet their daily commitments. These online retailers employ a mean of 7,327 people, making them major UK retail employers. They help the economy by providing jobs to a big workforce. Profit and loss data before taxes are next in our profitability discussion. Since the average profit loss before taxes is more than 7 million pounds, and these enterprises make a profit. The standard deviation of more than £54 shows that the aforementioned firms have a wide range of profitability. And the variations in firm structures, marketing, market positioning, and competitive strategies may cause this. Then correlation result. Here, the table reveals a minus 0.212 association between gearing percentage and liquidity ratio. This shows that a company leverage or gearing percentage and liquidity are moving somewhat negative. High gearing or debt financing lowers a company's liquidity ratio. Financial economics argues that larger debt levels raise a company's financial risk and restricts its short-term commitments. Workers have a substantial positive correlation of 0.127 with gearing percentage and a little negative correlation of minus 0.12 with liquidity ratio. This shows that companies with greater gearing percentages have more workers than those with superior liquidity. Larger enterprises need debt. Therefore, gearing proportion increases with staff count. The negative link between worker numbers and liquidity ratio shows that organizations with more cash manage their personnel better. Then next, panel regression. Here, profitability in the UK's online women's cloth retail market may be broken down using the supply table. Using the panel least square technique, we investigate what variables affect the profitability of these companies, with a particular emphasis on the profit loss before taxes. By analyzing the statistical measurements and coefficients, we learn how different factors affect the bottom line. First, the problem is that the gearing coefficient, which measures the amount of debt in the capital structure, fails to show statistical significance. This indicates that changes in the debt to equity ratio have no effect on the pre-tax loss in the women's clothes retail sector that operates online. The liquidity ratio coefficient also suggests that liquidity factors into profitability is very little. Therefore, it can be concluded that the liquidity to satisfy short-term commitments has a little influence in determining the pre-tax profit loss in this sector. In the coefficient for shareholders' funds, on the other hand, it's statistically significant, suggesting that more money from shareholders tend to boost profits. This research suggests that more capital from shareholders boost profits for women's apparel retailers operating online. Furthermore, the statistical significance of the turnover coefficient indicates that an increase in turnover has a beneficial effect on profits. This suggests a correlation between sales volume and pre-tax loss in this sector. Then recommendations. Here, the fund shareholders contributions affect pre-tax profits so much, so the retailers should focus on sustaining shareholders. Then optimize operations. Here, the retailers should emphasize value chain operational efficiency to stay profitable. And the inventory management and data analytics may enhance product selection, price, and stock levels. Then retail trends alter regularly. The retailers must monitor customer expectations, fashion trends, and technology to compete. Social media, fashion influencers, and customer feedback may indicate trends and expectation. Then we are concluding this report. So this research studies the factors affecting UK online women's clothes retail profit before taxes. So the findings showed that shareholders' money and turnover significantly affected profitability, underlining the necessity to recruit investors and enhance sales. So the retailers should emphasize investor relations and growth potential communication to concentrate shareholder money. Marketing, customer experiences, and strategic partnerships are needed to increase market share and customer loyalty. So the organization may save money and boost revenues by simplifying supply chain and integrating technology. By following these recommendations, we can help online women's apparel shops expand and profit in the competitive UK market. So these are the conclusions regarding our report. So thank you.